The best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares moved lower today to track regional movements in Asia. So the Straits Times Index was down at 0.64% at 4,192 points at about 11:41 a.m. Singapore time. And that is with a value turnover of some 782 million Sing dollars seen in the broader market. Now, let's take you through the closing numbers. As we shared with you earlier, the STI ended 1.08% in the red at 4,173 points. In terms of value turnover, we are looking at 1.9 billion Sing dollars. Gainers trailed losers 204 versus 388. Top advances for today, we've got for you Venture Corp, Prudential USD and Keppel Corp. And top decliners, we've got GMH USD, Jardine Cycle and Carriage, as well as DBS. Well, in terms of companies to watch, we have Keppel, because Keppel saw net profit rise 24.2% to 377.7 million Sing dollars for the first half ended June. And that is driven by growth in its real estate segment. Now, elsewhere from how Wall Street's AI heavyweights added a combined $500 billion in stock market value after quarterly reports from Microsoft and Meta platforms, to how investors' reactions on the trade deal between the US and South Korea looked like. We've got more international headlines in focus. And also on deck, how Fed officials held rates steady overnight. So lots prepared for you, and joining us on the line is David Chow, Director at Azure Capital. David, welcome back to the show.
Hi, Nintendo. Thanks so much.
And great to have you as usual. And David, let's start with global markets this time around. The latest developments on the trade front saw Trump announce a deal that sees 15% tariffs on South Korean goods. He also said India was to face 25% tolls. How are investors taking in all the news, not to mention the tariff on Brazil?
Right. I think over the past week, the market has come to expect more countries to reach an agreement with U.S. before the August 1st deadline, and there was also a lingering expectation that Trump would postpone the deadline. So, market was still, quite calm about it, even though there are still issues to be resolved, when it comes to countries like Brazil, as you highlighted. I mean, if I look at the VIX index, for one, it's still lingering at the 15 mark level, which is low compared to the high 30s and 60 levels we witnessed a couple of months back. However, this is not to say, calmness has prevailed in all asset classes. For emerging market currencies like the Indian rupee or even the Brazilian real, they have faced intraday volatility along with safe haven inflows to gold and treasury bonds. So going back to the tariff, I think the 15% tariff on South Korean goods is especially notable given the Koreans' role in the global tech and auto supply chains, and I think it would prompt investors to reevaluate these semicon and EV supply chains where Korea is a key player. As for Indian equities, which had recently enjoyed very strong inflows from our observations, I think we now face scrutiny over potential, measures or diplomatic tensions with the U.S.
Okay. And you spoke about the U.S., David. Fed Chair, or rather the U.S. Federal Reserve, held interest rates steady and refrained from suggesting that it would cut anytime soon despite relentless pressure from Donald Trump. Recent data indicating that inflation remains elevated, of course. So a widely expected move, David, given the numbers, but have investors gotten any clues from the Fed as to what is next in September, and how have U.S. markets and the dollar fared in response?
Right. It seems like the Fed chair was following his old script once again for the meeting this morning, when he emphasized that the Fed remains fully data dependent, especially regarding inflation and labor market dynamics influenced by new tariff policies. Hence, he's starting to sound like a broken recorder.
Yeah.
However, what is notable yesterday really came from two Fed governors, namely Christopher Waller and Michelle Bowen. They actually dissented in favor of cuts, and hence making the first dual dissent among governors minus since the 1990s. So, with a non-commitment to a timeline for Fed cuts, market have scaled back in terms of the interest rate pricing. Looking at the Fed Watch tool, it has trimmed the odds of September rate cut sharply from around, I think, 65% before the meeting to now, 46 to 48% thereafter. With this, it's not a surprise to see U.S. markets, getting softer, with this, and we have also seen, 10-year Treasury yields rising about 4 to 5 basis points, reaching 4.37%. And along with this, the U.S. dollar index also posted its strongest week, I think, since 2022. So, as expectation for near-term easing seems to have faded into the background for now.
Now, at the same time, a lot of things going on in U.S. markets. We are seeing a strong set of earnings from Magnificent Seven players, Meta and Microsoft. So just to look at Meta forecasts quarterly revenue well ahead of Wall Street expectations and raised the lower end of its annual capital expenditures forecast by $2 billion, driven by high-stakes push for super intelligence in that heated AI race. So if we look at Wall Street heavyweights, the numbers drove stocks higher. Wall Street's AI heavyweights, they added a combined $500 billion in stock market value. How to read into investors' reactions? Have they gone ahead of themselves?
Right. So Meta's revenue beat and even raised CAPEX guidance, so particularly for AI infrastructure, affirms that AI investments for now is not just a narrative but translating into real spending. That Meta is willing to raise its spending plans. Mid-year shows high convictions in long-term AI monetization, and this reaction wasn't confined to just Meta and Microsoft. I think the search across other Magnificent Seven names suggests markets are still in buy everything AI mode, a sign of both belief in secular growth and perhaps a bit of momentum chasing. So taking this CAPEX expenditure as a signal, this upward revision of CAPEX really show how serious major players are. As we have dwelled into them for the past few weeks. So if you ask me whether investors are getting ahead of themselves, many of if you look at the Magnificent Seven, they are trading at rich multiples, pricing in years of AI-led growth. So, for example, even slight disappointment in CAPEX ROI, regulatory headwinds, or delayed monetization could trigger sharp corrections for them. So, and looking at the seven of them in terms of share price action, I think you saw a massive 500 billion gain. This 500 billion gain, I think, is really a massive figure. It's like many times more the GDP of many countries. So while earnings justified some optimism, the scale of the move may reflect speculative positioning and not just purely fundamentals.
Okay.
So what do you think, Gideon?
I guess we have to wait and see how all that pans out and also the use cases of AI. But let's go back to the Singapore stock market as usual. Sure. David, how did the STI fare today, and any surprises when we look at the biggest movers and the sectors that they lie in? A lot of S-REIT earnings, and we've seen earnings from Seatrim as well, and shares tumble 5.4% early on.
I think finally we are seeing some consolidation coming in to the STI, where it's now down nearly 1+%. And of course, this will be due to weaker U.S. markets. Of course, coupled with overextended rally in the STI, and possibly getting some negative spillovers from the China markets, which fell about close to 2%. From news of Chinese authorities, summoning NVIDIA representatives to discuss security risks with regards to its H20 AI chips. So for S-REITs today, I think still will be a non-event. But if you mention Seatrim, they have been hitting the spotlight, as many of us know, for the past 2 days, with firstly the conclusion of the MAS and CAD investigation, and the fines that they have to cough up to settle this suit. And their results announcement released early this morning also shed further spotlight on them. So commenting on the share price action since yesterday, main share price was initially down after trading halt was lifted following the release of the investigation outcome. As the market was coming to terms with it, and most participants probably realized that an overhang had finally been removed, and with anticipation of the results released today, share price actually climbed back up and closed strongly at the end. So for this morning's result release, first half net income of 144 million was a huge jump over its previous first half net income of 36 million, 400% increase, and the core profit also came in strong at 130 million, and I think this figure alone formed about close to 40% of the market consensus for the full year. So in the second half, Seatrim is still expected to record a higher net income in order to meet market expectations. Yes. So gross profit margin of around 7% was also around consensus level. But what is of concern, a slight concern perhaps, is that the net order book of 18.6 billion is actually lower than the 21.3 billion recorded in the first Q of 25. So market was expecting some new order wins which will surpass these numbers in the first Q, but it never came. So the buzz on the market is that there may be some brokers, in the coming days, they may start to revise down their forecasts, in terms of numbers, and hence their target prices for the year. Hence, this actually led to a 5.4% decline. So we shall see.
Okay, and let's zoom in on another company to watch, David, and that is Keppel. So if we look at Keppel, it saw net profit rise 24.2% to some 377 million Sing dollars for the first half ended June, driven by growth in its real estate segment. The profit growth came even as revenue fell 5.2% to 3.1 billion Sing dollars. What do you make of Keppel's latest results?
Right. So with this discrepancy, the question will be, so what went on in between the top line and the bottom line? So with these results, to us, it's a clear reflection of his strategic pivot and asset-light transformation. So this divergence actually points to improved margins, higher returns from investments, and you can even cite successful asset monetization as a key reason, which is really a hallmark of Keppel's ongoing shift from a conglomerate to a global asset manager. So this profit growth, if I look at it closely, was primarily driven by real estate, suggesting strong performance from Keppel Land and possibly higher fee income of fair value gain from its property assets. And this will also reflect contributions from Keppel managed funds and capital recycling efforts, which have been central to its new model. So with declining top line but rising bottom line, Keppel is also showing to a certain extent signs of effective cost control and strong operating leverage, which is really key for an asset manager that generates profit more from management fees, carry interest, and investment gains than traditional revenue. So if you delve into the reasons for the revenue decline, I guess the 5+% decline could indicate muted performance in areas like infrastructure, data centers for now, or other legacy business. But through the bottom line resilience, it actually suggests any shortfalls were actually well managed or offset.
Okay, and further away, David, we do want to take a look at results out of super app Grab. Grab reported Q2 2025 earnings of $35 million, reversing from this loss of $53 million we saw in the same year-ago period. Any thoughts on the latest numbers this time around?
Okay, I would think that the latest numbers imply that operational discipline is paying off. We are seeing margins improving and unit economics tightening. So when earnings turn positive or even modestly for this case, I think it really sends a strong psychological boost and prove that the business is nearer to break even or profitability by scaling. And this is something which Grab has been striving to do for a long time. And looking at the various segments, fintech, delivery, and ride-hailing segments appear to be accelerating tractions, and this is important. So the next consideration will be, can this earnings momentum continue into 3Q and beyond? So even with positive net income, cash burns or investment in growth, I would think that these three would remain critical to their businesses going forward. But it's still, most importantly, is what's the guideline for financial guidelines for Grab in the 3Q. And I think looking at the results this morning, I don't think I've seen that. And all I've seen is that in its recent trading updates from the April to May period, the company actually shared some solid year-on-year growth matrix, like I think 19% GMV growth, 23% rise in rides, and I think 20+% rise in delivery. And it did not provide any forward-looking revenue or profit guidance for the next quarter. So I guess going to the next quarter, we have to again wait and see.
Okay, and finally, before we let you go, David, we can take some time with this one. ChatGPT maker OpenAI roughly doubled its revenue in the first 7 months of the year, reaching $12 billion in annualized revenue. Now, this is according to a report by The Information, citing a source. And we do want to clarify, Reuters could not immediately confirm the report. OpenAI declined to comment on the matter. But if it turns out to be true, then $12 billion in annualized revenue. What does it say about the current AI boom in terms of firms' ability to monetize AI-enabled solutions?
I suppose if this is true, the sharp revenue acceleration will actually suggest that businesses and individuals continue to adopt generative AI tools at a rapid pace. The fact that OpenAI could scale so quickly, points to strong real world utility, and not just merely speculative interest. And I would say that to a certain extent, enterprises will play a vital part as well. Companies across industries are perhaps integrating AI into their workflows, customer support, software development, and even content creations. And with this, it seems to validate the willingness of businesses to really pay for productivity enhancing tools, especially when bundled with platforms they could already be using. And lastly, I think we are probably seeing a sustainable cost structure too. I mean, there were concerns earlier on about whether AI infrastructure costs, such as your GPUs, your electricity, could be offset by revenues. So this kind of growth suggests OpenAI is at least partially achieving some forms of operational leverage, meaning it's making more per dollar of input than before.
I see. Lots to watch as usual. Thanks so much for the insights, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.